Hi, good afternoon. This meeting of the Audit Committee is called to order. First order of business, are there any public speakers?
There are no public speakers.
Very good. No public speakers. Then we'll move to the approval of the minutes. Can I get a motion to approve the minutes? Second?
Second.
All in favor?
Aye.
Motion passes. Then we'll go to the work plan. Any changes to the work plan?
No, there are no changes to the work plan.
All right. Hearing no changes to the work plan, we'll go to management's review of the consolidated financial statements.
And Pat Kane.
Okay. How's that? Good. Okay. Let's see. Okay. Okay, I'm going to go over the MTA's fiscal year 16 consolidated financial statements. This is in the exhibit book on Director's Desk. It's item number 4, page 14. So the consolidated financial statements are the consolidation of all the financial statements of all the agencies, including all intercompany eliminations. They're prepared in conformity with generally accepted accounting principles in the United States, using accounting standards established by the Government Accounting Standards Board, otherwise known as GASB. They include 5 sections. The first section is the MD&A. Then we have the basic financial statements. We have the footnotes to the financials. We have required supplementary information, RSI. There's 5 detailed schedules of additional info on the MTA's pension plan and OPEB obligations. And then finally, we have something that may be unique with the MTA is an additional supplementary information, which is a reconciliation of the audited revenue and expenses to the financial plan estimated actual presented at the February Finance Committee. So for 2016, we had 6 new GASBs that applied to fiscal year 2016. Thankfully, only one of them applied to the financial statements. That's GASB 72. So in GASB 72, we saw this earlier in January in the pension plan financials, and basically that's the disclosure that requires basically the fair value hierarchy of investments, different levels, level 1, level 2. This has been fairly standard disclosure in non-government financials probably for the past 10 years, so the GASB's kind of catching up on this one. You can see that in Note 3 in the financial statements. Okay, so we're going to take a look at the MTA's balance sheet, if you will. In GASB, it's known as the Statement of Net Position. So in the Statement of Net Position, we have assets. The assets at the end of 2016 were $73.7 billion. The largest number there, obviously, is our capital assets, net, $64.3 billion. Then we have something called deferred outflows. This is unique to government accounting. You won't see this in any other non-government financial statement. So deferred outflows, what are they? Well, they're basically outflows and inflows of resources, just like revenue and expenses, except that they don't apply to the current period. So these are outflows that really apply to future periods. So a good example there would be in our deferred outflows for pensions. We have pension contributions that were made in fiscal year 17, which are after the measurement date. So the pension plan measurement date for the MTA is January 1st because it takes a long time to gather the information to measure the pension liability. So under the new GASB, any contributions that we make from January through December basically get deferred because they will be expensed in a future period. So that's an example of deferred outflows, and we also have deferred inflows, which is just the opposite of that. So next we have our liabilities. Liabilities are $71.7 billion, and you can see the largest there is our long-term debt, $38.9 billion. We have post-employment benefits other than pension, otherwise known as OPEB, $15.1 billion, and a net pension liability of $8.9 billion. And then we have our deferred inflows of resources of $324 million. Okay, next we'll take a look at some of the variances on the assets and deferred outflows. So the biggest variance there, the biggest increase, is on our capital assets. Our capital assets increased $2.9 billion in 2016. Our capital assets, we had $5.4 billion of additions, offset by $2.5 billion of depreciation. In our deferred outflows, that increased by $1.4 billion, and that increase was $155 million swing in the contributions, and $701 million of basically actuarial losses. So that's the difference between our estimated return on our investments and our actual. So that will be amortized out over the next 5 years. Okay, taking a look at our liabilities, we have liabilities of $71.7 billion at the end of 2016, an increase of $5.4 billion. And you can see the top three are the biggest reason. Our long-term debt increased by $1.8 billion, our OPEB liability increased by $1.5 billion, and our net pension liability increased by $1.3 billion. The OPEB liability increased primarily because we fund OPEB on a pay-as-you-go basis. So the OPEB funding, we're funding the current cost rather than the actuarial determined amount. So that difference would be $586 million is what we actually funded, versus the actuarial determined amount would be $2.1 billion. Okay, next we have our net position, which is the equivalent of equity in the private sector. So net position is our assets less our liabilities. So real quick, the total net position is for the MTA is $5.5 billion, and we break that down by different categories. So we have net investment in capital assets of $25.5 billion. And if you take a look at our total capital assets, it's $64.3 billion. If you subtract our long-term debt, which is all for capital, $39 billion, that leaves you with $25.4 billion. Restricted for debt service is simply the funds that are remaining in debt service accounts after we sell our debt. So that's kind of a timing issue there. We have unrestricted of negative $21.5 billion. And I think the easiest way to explain that is if you look at our OPEB liability, it's $15 billion, which is unfunded, so we don't have a matching asset for that. And our pension liability is $9 billion. So right there you've got $24 billion of unfunded liabilities, which is primarily what causes that unrestricted to be a negative net position. Okay, next we take a look at our statement of cash flows. Our cash flows for fiscal year 16 increased by $278 million. Going through the categories, our net cash outflow from operations was negative $3.4 billion, or $348 higher than last year. Our net cash inflow from non-capital financing activities, those primarily are our subsidies and our tax revenues, was $48 million less than last year. And our net cash from capital and related financing activities was negative $3 billion, or $887 million greater than last year. But offsetting that was our net cash flow from investing activities, which was positive $141 million versus negative $1.2 billion last year, resulting in an end-of-year cash of $732 million. Next, we'll take a look at our statement of revenues, expenses, and changes in net position. So what we have here is we have our operating deficit for fiscal year 16 of $7.7 billion versus $6.9 billion the prior year. We have a deficit before capital grants and appropriations of $2.4 billion versus $1.6 billion last year. And then we have something that you typically don't see in your monthly finance report. We have our revenue from capital grants and appropriations of $2.079 billion. So that was $100 million better than last year, resulting in a total change of net position for the year of a reduction of $343 million. So when you add that to the beginning net position, results in a net position for the end of the year of $5.5 billion for the year. And then next we have a reconciliation. So what we do here is we reconcile the financial plan estimate that was presented in the February Finance Committee to the audited financial. So if you look at the net operating deficit, the financial plan had a net operating deficit of $7.9 billion. The audited financial statements are coming out slightly better of $7.7 billion, but pretty close. So slightly lower by $112 million. And then we come down to our surplus and deficit before capital grants and appropriations. The financial plan has $921 million positive, and the financial statement, audited financial statements have negative $2.4 billion. And on the next page, we'll do a reconciliation of how we get to those differences. So in the top part, we have our financial plan operating loss of $7.9 billion. We have the various items that make up the differences between the financial plan and the audited numbers. The $112 million brings us down to the audited financial statement operating loss of $7.7 billion. Then the financial plan has $921 million. Financial plan basically adds back non-cash items of depreciation, unfunded OPEB, unfunded GASB pension adjustment. We have a difference in debt service. In our financial statements, our debt service is interest expense, but in the financial plan, they count interest and principal because they're both cash items. So that brings us down to $4.5 billion of reconciling items. If you add back the operating difference of 112, it brings you down to the audited financial statement loss before capital grants and appropriations of $2.4 billion. Okay, and finally, as of April 24th today, MTA management is in the process of finalizing several prior period restatement adjustments, which are not material and non-cash and therefore have no impact on the MTA's reported cash flows. A major part of these restatement adjustments go back many years, over 20 years, and they really involve classification of capital assets between depreciable and non-depreciable categories. These adjustments will primarily affect the statement of net position and reflect an increase in prior year's balances for capital assets and net position. Okay, that's my presentation. If anybody has any questions.
Hearing none. Thank you, Mr. Kane. What I think I've just learned is we are a transportation/pension corporation. With no questions on that, we will move on to a conversation with Mike Fritz and the team from Deloitte on the draft 2016 financial statement.
All right. Thank you, Mr. Chairman. As I'm beginning my discussion with you, my senior managers are passing out the required communications under generally accepted auditing standards, which will basically be the focus of my presentation with you here this afternoon, but we're also available to answer questions. With me here at the table, I have the partners and directors that work with me on this engagement. I have Chris Hickman, Greg Koslow, and John Young, and they are the individuals that actually sign the various opinions at those entities. If you focus on the first page of the report that was just handed out to you, we are in essence ready to issue the financial statements on FMTAC, the Long Island Railroad Company, Metropolitan North Commuter Railroad Company, the MTA Bus Company, Staten Island Transit financial statements. Those, as Pat mentioned before, are not impacted by the adjustments that management's looking at to perhaps have some adjustments to the prior period beginning balances of net position. However, as it relates to transit and TBTA and MTA headquarters, those are the entities that are impacted by the adjustments that management are looking at. As Pat mentioned before, they represent items that are, though not material to your overall financial statements, they still are amounts that are in the $700 million range as it relates to beginning net position. It actually is an increase to net position as opposed to a decrease. Management can share with you what those details were if you want to dig into it, but it has no impact on your operating expenses. It has no impact on your cash flows. These are non-cash items. In terms of the other items I need to share with you in terms of our required standards, on page 2, we will be issuing an opinion on your financial statements in accordance with generally accepted government auditing standards. That will also include some additional paragraphs as it relates to supplemental information that are included in the financial statements, the changes in your pension obligation, and some of the other budgetary information that you have in those financial statements. We will have an opinion on internal controls as it relates to the financial reporting. And we will also express compliance in accordance with Uniform Grant Guidance Guidelines. That's the old A133 single audit. That will be presented to you in June. On page 3 of that document, we highlight significant accounting policies. There was one change in accounting policies this past year. It related to the disclosure of investments and the leveling of those investments. It's very similar to what corporations do, and your investments are now categorized by risk as to level 1, 2, or 3. Level 1 would be things that have readily available market conditions. You can go to the Wall Street Journal, you can price those investments, you can see them. Level 2 relates to items that are, somewhat they'd be more like mutual funds. You have to dig into the financial statements a little bit more. Level 3 investments would be items where there's a significant estimate done by the party that provides you that information, and it could be a limited partnership, it could be an alternative investment, or things of that nature. Most of your investments are level 1 and 2, readily available market types of information. In terms of accounting estimates, when we shared the risk of our audit with you earlier in the year, we talked about the major estimates in your financial statements being the pension obligation and OPEB. And as Pat mentioned to you a few minutes ago, you can see that significant liabilities in your financial statements relate to those estimates. We do subject those to having our actuary look at the results of what was done by management. We challenged those estimates and we were comfortable with them. And we also look at the reserves for self-insurance liability. Those are the 3 major estimates. There were no changes in those estimates from prior years. In terms of uncorrected misstatements, there were no uncorrected or past adjustments as a result of the audit. There were no material corrected misstatements as a result of our audit, and the reason why I say that is management has actually on their own taken the position of actually restating the financial statements. We believe it's important and we agree with what they've done, but they brought those items to our attention and we've worked with them on how the presentation of that should be within the financial statements. We have no disagreements with management, and on page 4, you will see that we had no significant difficulties with in performing our audit. As usual, we provided you with drafts of the management representation letters of the various entities. That's what makes that package so thick. It's the draft letter that relates to everything that the management of those various entities will be signing before we would issue the financial statements. If you look at the bottom of page 4, that basically highlights those past, or not the past adjustments, the adjustments that management will be working on before the financial statements are issued for MTA, for transit, and TBTA. It gives you a little more detail about what the items are, but again, it's almost all beginning balance relating to the capital assets. In terms of our opinions, they do have emphasis of matter paragraphs in them. That means that we want to bring something to the attention of the reader of the financial statements. That paragraph 1 is comprised of the fact that you are a component unit of the state. Therefore, we have to tell the reader of that And we also have some information in our opinion relates to the supplemental information that's included in the financial statements. None of those paragraphs are qualifying language as it relates to our report, so they are unmodified, or they are clean financial statement opinions. The one item that we are still working with, and this will be based upon the results of management's completion of their estimates in the financial statements, and that is whether or not we have an emphasis of matter paragraph as it relates to the restatement of the beginning balances. Because the amount is large, there will be a footnote in the financial statements that basically crosswalks the reader from the previously reported information to what will be in the revised statements and those beginning statements and net assets. Under generally accepted auditing standards, we're required to consider the materiality of that amount to our financial statement opinion. If, in fact, we believe that we need to make reference to that footnote, that might be an additional emphasis of matter paragraph, but that, again, is not a qualified opinion. You're getting an unqualified opinion regardless from us as to which way this turns out. And that would really be the end of my presentation. I'd be glad to answer any questions or have my associates here answer any questions that you might have on the specific financial statements themselves.
Questions or comments? Well, if there are none, Mr. Kane, would you like to make a recommendation?
Yes. We recommend that the Audit Committee approve the release of the 2016 financial statements. We make this recommendation conditioned upon non-material final audit adjustments relating to the Transit Authority and Triborough Bridge and Tunnel Authority and the Consolidated. These will be reviewed by Deloitte in conjunction with the Chief Financial Officer and the Auditor General.
Thank you. Could I have a motion? Second? All in favor? Motion passes.
Good. Number 6.
Number 6.
Lamont Curse.
Lamont Curse, financial interest reports.
Yes, everybody's favorite subject, right? Okay. If you turn to your committee books on page 574, I'm sorry, 571, you will see a letter, a memo that was sent out from me to all financial disclosure filers, reminding them of their obligation. This year we have over 7,000 employees and board members who are required to file a financial disclosure statement this year, and we have been in touch with each and every one of them. Following that is the memo that I sent to you and your fellow board members, reminding you of your obligation to file. Again, if you have any questions, I am always available to assist. Finally, there's a memo from me to this committee reaffirming the MTA's commitment to ensuring compliance with the requirements of the financial disclosure statement. As of today, we have been notified by the Commission of a total of 21 employees who did receive notices of delinquency last year. Of those 21, they have all filed as of this date. We have determined that the majority of those individuals did not file because they were first-time filers who determined that the email they may have received from the Joint Commission was an error because they have never had to file in the 30 years they've been MTA employees. But we communicated to them this new requirement, and they have all filed at this point. If you have any questions, I'll be happy to answer them.
Questions, comments? Things we don't want to hear again. Page 571 of your committee book.
Okay.
All right, thank you very much. Moving on to Michael Gartner and the DDCR performance measures update.
Afternoon. We are charged with coming back and reporting our results with respect to closeouts. As of March 31st,
Mitch, you have any accounting jokes while we wait?
Great. As of March 31st of 2017, there's been 1,139 projects closed out dating back to 2002. Next page gives you a graph of the progress that we've made since tracking this. Next page. Site visits. Each manager who we have an obligation to conduct 8 site visits per month for an average of 50 a month. And so some months you may have more than 50, others less than 50, depending on some of the weather that we experience in the wintertime. So that's why it's an average of 50 per month. We take these site visits like very, very seriously. And focus on MW, DBE, contract compliance issues, where there are issues that we think rises to the level of fraud. Those issues are referred to the IG's office. Let me also want to circle back to Mitch's question from the last audit meeting that we had of whether or not in our new B2G system, if all of the 96 state agencies and authorities can share the results of our third-party contractors and consultants, and the answer was no because of confidentiality issues. But note and understand that we have joint events with other agencies, and if there is a recurring firm who are failing to meet their MWDBE requirements, that word spreads.
My concern, because obviously one would assume that the same companies participate in a variety of different agency procurements or whatever, however that is, and if one entity doesn't know that the contractor did not fulfill their requirements with them, then we could award a contract for somebody who was in violation with somebody else, the Port Authority, State DOT, City DOT, and up and down the line. So that was my concern, that I wanted to make sure that we had the appropriate information to know that when we award one of these contracts and an MBEWB firm is selected, that everybody from the contractor to the subcontractor has met their requirements.
Yes. Yes, got it. And as you know, that we do track that MTA-wide.
Right.
Based upon the staff summaries, we are indicating the history of that firm in achieving their MWDBE
right.
contract
But in that context, you're not doing it just with the agency awarding the contract, you're doing with all of MTA's agencies.
Yes.
So that if somebody didn't do it for the Staten Island Railway, we know that at Long Island Railroad. The issue was, of course, going beyond the MTA family to other state and local entities, but I guess we can only do what we can do.
Yes.
Got it. Thank you.
And I want to just close by saying, you know, George Steinbrenner always says that it takes money to make money. And as we've been having internal conversations about the new 5-year capital plan and the volume, what that would mean for our staffing, and we've had internal conversations about hiring more staff to effectively monitor the MWDB results on our projects that's yet to be awarded. So those conversations are in fact being had right now.
And has the organization been receptive to?
Yes, yes. Let me also thank Mike and Internal Audit, because as opposed to just serving as an auditor and coming in saying we got you, we worked together, and Mike has been gracious enough to lend staff support to areas in which we need to do a more effective job of doing so. Thanks, Mike. And also Michelle Woods. I mean, she's a walking encyclopedia of MTA history and a working knowledge of where the problems are and what it takes to fix those problems. And so she's been like invaluable. So thank you.
And Michelle's with my staff, so you know.
I think before we take questions, if there are questions or comments, I want to thank you and your staff. I joke about the 571 pages, but there's 571 pages of incredibly important stuff to this organization in each of your respective areas, and I know an immense amount of work went into achieving these kind of numbers, into getting the audit into a form where we can be recommending it. So Lamont, Pat, Mike, Bob, your team, Mike, your team, and our partners at Deloitte, we thank you guys very, very much. We really do appreciate it. With that, are there questions or comments on the DDCR performance measure?
I just had one question. Today at Metro North Long Island Railroad, we awarded a contract for the state of Connecticut that I guess they're paying, that we award. And in there was a statement from the state of Connecticut that there was 0 requirements for MBWBE status. Do you review their statement to say, wait a minute, there can be, or how do we relate to that? Because obviously from our perspective, we would prefer to be for that contract to meet the 10 or 15% requirement that all of our other contracts meet, and it just seemed to me strange that the last statement of the staff summary said 0.
Right. Let me follow up on that, because I know historically speaking there was cases in which their money was paying for the product or the service. The FTA honed in and indicated that since their monies were in fact paying for it,
Right.
then they were the ones who needed to establish and enforce the goals.
But if they, understanding that, and if they decide that the goal is 0, which is what it said, do we have any authority, power, influence, whatever terminology we want to use to say, wait a minute, this is actually an MTA contract, this board is awarding the contract regardless of who is paying for it, and we don't like contracts that have 0 in the last sentence. We would prefer the contract have our own requirements, which is significantly higher than 0.
Yes. Let me follow up on that one issue, and I will brief you, and I'll copy the
because it will be on the board agenda on Wednesday.
Got it.
And as I said, it just kind of like stood out to me, because normally I read the contracts and it says, there's a 10 or 15 or 20% or whatever it is.
Right.
And 0 just kind of like stood out like a sore thumb.
In the past, when there was a second issue like this, previously speaking, the FTA honed in because we wanted to force them to assign goals, and the FTA had honed in and says if they're paying for the project, then their MW or DB requirements prevail. But I will circle back.
Okay, thank you.
Okay, you got it.
All right, if there aren't other questions or comments, I'm going to ask for a motion. I'm going to make a motion to go into executive session pursuant to New York State law in order to discuss certain pending litigation matters and matters related to the finalization of our financial statements. A motion to go into executive session. Second. Thank you. Motion out of executive sessions. There you go. So moved. Motion to adjourn.